Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden messages in corporate filings, and boy, do we have a story about debt and future promises for you today. Today we're looking at CNX Resources Corporation, a company whose name might sound familiar in the energy sector. They've just dropped a current report, an 8K filing, and it is packed with news about a significant financial move they've made. Think of it as a company updating us on a big event that just happened. The main event here is that CNX Resources has successfully completed a big private offering, or a way of borrowing money from investors. They raised a whopping $500 million by selling what they call senior notes, which are essentially IOUs that mature in 2034. So what does that 5.875% really mean? It is the interest rate they've agreed to pay these investors every year. It is like renting money, and this is the rent they'll be paying. They'll be paying this interest twice a year, on the 1st of March and the 1st of September, starting in September of 2026. The loan itself, the principal amount, is due back to investors on the 1st of March 2034. Now, about where these new debts stand. These 5.875% notes are considered senior. That means if things go south and the company can't pay everyone back, these note holders get paid before anyone who lent them money that is considered subordinated. It is like people who are first in line for a slice of pizza. Here is an interesting part about how they can pay back these notes early. Starting in March of 2029, CNX Resources has the option to buy back these notes before their 2034 due date. The table shows they can do this at a slight premium. For example, in 2029, they can buy them back at 102.938% of their face value. It is a bit like saying, we'll buy back your loan now, but we'll pay you a little extra for the convenience. They also have a special trick up their sleeve. Before March 2029, they can use money they raise from selling new stock, called equity offerings, to buy back up to 40% of these notes. This is often done to manage their debt structure or take advantage of favorable market conditions. It is like using new shiny coins to pay off old debts early, but with a limit. And then there is this applicable premium. This is basically an extra cost they might have to pay if they want to redeem these notes anytime before March 2029. The exact amount is defined in the big legal document, the indenture, but it means they're being given flexibility, though it might come at a higher price. Now, every big loan comes with strings attached, and these are called covenants. The indenture, the main agreement for these notes, lays out a bunch of rules CNX Resources has to follow. They can't just go out and borrow an unlimited amount of money, can't sell off too much of their stuff without conditions, and they have to be careful about how they spend money or deal with their subsidiaries. It is like a parent setting rules for a teenager, ensuring responsible behavior. The good news is, if their credit rating gets good enough, some of these rules will actually disappear. That is a big incentive to manage their finances well. Of course, there are also consequences if they break these rules or can't make their payments. These are called events of default. This includes missing interest payments for too long, failing to pay back the principal when it is due, or even significant financial trouble like bankruptcy. If one of these happens, the people who hold the notes can demand their money back immediately. It is the ultimate pay up or else clause. And a really important one for investors, if there is a major change in ownership or control of CNX Resources, the note holders get a say. They can actually force the company to buy back their notes. This protects them if a new owner comes in and has a completely different plan that might put their investment at risk. They'll offer to buy them back at 101% of the principal amount, meaning a little bit more than they paid, plus any unpaid interest. This next section is basically a formal acknowledgement that they've taken on a significant financial obligation. It confirms that this new debt from the notes is now a direct financial commitment of the company. Think of it as signing on the dotted line for this massive loan. And because this financial news is important for everyone to know, CNX Resources also put out a press release to announce the closing of this notes offering. This is part of a rule called Regulation FD, which basically means companies have to share important information with everyone at the same time, not just a select few. So this press release is essentially a public announcement confirming that they successfully got that $500 million. It is their way of saying, deal done. Finally, we get to the list of all the important documents that go along with this report. This is the actual detailed legal contract for the notes. The indenture. It is like the full rulebook for this debt, and the press release we just talked about. So what does all of this mean for CNX Resources? They've clearly decided to borrow a substantial amount of money, extending their debt horizon out to 2034. This suggests they likely have plans for this capital, perhaps for future investments, acquisitions, or to refinance existing debt. The 5.875% interest rate is pretty standard for the current market, but it is still a significant ongoing cost. The covenants are important. They show a commitment to financial responsibility, but also highlight potential constraints on their future actions. A key risk here is always interest rate changes and their ability to service this debt, especially if their business performance falters. However, the fact that some covenants disappear if their credit rating improves is a smart way to incentivize good financial management. In my opinion, CNX Resources is making a confident move by securing this large sum of capital long term. It signals a belief in their future prospects and their ability to manage this debt effectively. The main opportunity lies in how they deploy this capital to grow their business and generate returns that outpace the interest costs. The primary risk is the continued volatility in the energy sector and the potential for economic downturns that could impact their ability to meet these obligations. Overall, the company seems to be strategically positioning itself for the future, but the execution of those plans will be critical. Alright, that is our breakdown of CNX Resources' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.